Traders Corner is proudly brought to you by IG, the specialists in CFD trading.
Welcome back. You're watching Traders Corner, and as always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome. Interesting times on the markets, especially for the traders out there at the moment. Firstly, what did you make of yesterday, and how does that all play into the short position, essentially, that you have on the market at the moment?
Yeah, well, yesterday was crazy. I think it was probably the craziest day that I've seen since 2008. Our top 40 futures went limit down. At one point during the day, they were down 5%, which is the daily limit. They were down over 2,000 points for the day at that point in time. And then the limit down circuit breaker had to be readjusted to -7% to allow trading to resume. So it was a really, really crazy day. I haven't seen that kind of volatility, as I say, since 2008, and it's not fun. It's definitely, it frays your nerves to be involved on a day like that.
Yeah, so even though today has rallied spectacularly from that, yes, nerves are still jangling, shall we say?
Yeah, for sure, for sure. But you mentioned our option structure and the top 40 put spread that we've done. And it actually, we are sitting quite good in that situation at the moment. So let's have a quick look. The chart of the top 40 is up on the screen. And this head and shoulders pattern, which we've discussed so many times on the show, has now finally played out. And it's played out in a spectacular fashion over the last 2 days. And you can see that it's gone down. It's met the target, which is at around about 41,500. And you can see that from October and December of last year, there is an area of lateral support down at that 41,500 area. So we do seem to be bouncing off that level today. But, you know, so that's good news, but don't get me wrong, there's technical damage done here on this chart. There's plenty of technical damage that's been done. And this area up where the neckline of that head and shoulders pattern will now be quite stiff resistance on any rally that we see. So I think any move up towards 45,000, 45,500, if we even get that high, is probably likely to be met with quite a heavy resistance. Okay. So certainly we're not entirely out of the woods, but for now we are. I think we've got a nice bounce on our hands for now, but on a medium-term picture, I still think we've got to be quite careful.
Okay, so then how it plays in with the option structure that you've got on the go? You are probably firmly in the money, but can you cash in? That's the problem.
Yeah, that is the problem. So we're firmly in the money. This is the payoff profile of that put spread option structure that we've done for the portfolio. And as I've said all along, the profitable zone is between 42,000 and 44,000 on the top 40 future. And now this runs out to the September futures closeout, which is the 17th of September, okay. So about 3 weeks' time. Now, where we are at the moment is we're actually a bit higher than that now, but I obviously prepared these slides earlier this morning. And we're in that perfect sweet spot zone where we've got our maximum profit of 16,448 Rand being offered to us in effect. However, the question is, can you just close it out? And no, you can't. I've put this as a linear payoff as it would look on the futures closeout in September. The reality is that options pricing is quite complex, and you've got volatility and theta and all types of different mathematical elements to take into consideration. So I can't simply go and lock in the profit on this thing as it is right now. If I was to try and lock it in, I wouldn't get that full 16,500 Rand. I'd get a lot less than that. But I'm showing it here as if it was on futures closeout. And yeah, so provided we sort of stay in that zone by the 17th of September, we'll make our money. But of course, the 17th of September is a very long time away, and in markets like this that are swinging 2,000 points in a day, you know, anything can happen between now and then. But anyway, you know, suffice to say, it is looking good for us, and we did put the protection in place with the view to the market pulling back, and that's exactly what's happened. So, you know, looking at it another way, you can overlay this option structure onto the chart of the top 40 future over there, and you can see that we've traded right down all the way into this profitable zone on our structure now. So, you know, if we stay between 42, 44,000, that sort of area, we'll make good money on this thing. But I mean, anywhere between really 46,000 and down to about 40,000, we're going to make something out of it. So I'm inclined not to fiddle with it too much at the moment and just let it be and run it out to close out.
Okay, so sort of no rejigging or interference with that structure as it stands. You'll take what comes on the 17th of September.
You know, we remember last year this time, or almost this time, it was in October 2014, we had a similar structure on, and I decided to buy against it, and then the market fell very heavily. And I learned a big lesson that time because we potentially stood to lose quite a lot of money. You know, these structures are great, provided the market moves into an area, but if it starts to fall out the bottom of that structure, you can see there is a danger zone.
Yeah.
And if you then long against this futures as well as you've got the structure, you kind of double up your trouble. So from that point of view, I'm inclined to rather just leave it alone for the moment and let it be, and let's run it out to close out and let it expire.
Yeah, because then at least your risk is capped. It was the premium that you paid away, and you won't have to put any money in further.
Yeah.
Garth, that drop in the market looks quite dramatic, but I suppose it's mirrored exactly on what happened to US markets, in fact, especially on US markets. And I know you've got a chart of the S&P 500 you want to highlight.
Yes, well, this is the S&P 500, and I mean, if ever you wanted proof of the saying that the bull climbs up the stairs and the bear falls out the window, I mean, this is absolute proof of it. Look at that sharp drop that we saw there yesterday. I mean, really, a week ago we were sitting here and the S&P was up at 2100. A week later we're sitting and it's been down 11% since then. Obviously, it is looking like it's going to catch a nice bid today, but that trading action over the last 2 or 3 days has really been something unbelievable. And what I really want to talk about here is the volume spike, because this is what really is very, very interesting. And it's difficult to look at that chart and say, you know, can we find any technical support? It's really difficult when the market does what it's just done to apply your ordinary technical supports. Very often, the market will just find a level where the capitulation reaches fever pitch, and then it bounces, and it might not be at any specific technical level, really. And I think that's what we're seeing here. Now, notice I've circled the areas on this chart where there have been volume spikes in the past.
Okay.
And you can see back in October last year, in 2014, and then also in end of January 2014, we had a fairly sharp sell-off. Look, this one that we've seen over the last few days has certainly exceeded any of those prior sell-offs, but the principle remains the same. Have a look at how the volume spiked on those previous sell-offs at exactly the bottom. And again, we've seen a huge volume spike yesterday on the S&P 500. I mean, that volume bar is the biggest volume we've seen in over 2 years on the S&P 500. It's more than double the average daily volume that we traditionally see trading on the S&P. And what I like about these, and in terms of the volume spike and what it means from a psychological perspective, is that it implies that the selling has reached a capitulation stage. And it always invariably is marked with massive volume. And the thing about the massive volume is you've got to look at it from two perspectives, because a lot of people will say, oh, yes, well, there was a hell of a lot of selling, and that's what caused the volume to spike, because there was so much selling happening. Well, that's only half the story. The truth is that there was a lot of selling, but there was also a lot of buying, because the volume can't be there just with selling. There have to be buying orders to match it. And the way these panic sell-offs typically end is with panic selling and panic capitulation, just get me out at any price type of attitude by the sellers. And usually the sellers will exhaust themselves, and that usually comes at exactly the time when the volume spikes, because that's when the most irrational selling is happening. But at the same time, you've got rational buying happening on the other side of that, bargain hunting, if you will. And once the dust settles, the thinking is that those who are selling, the panicky, irrational sellers who were losing their minds, have now sold their shares into the hands of new owners, and those new shareholders now have bought their stock at a great price. They've bought at a bargain. They are in a far stronger mental place or mental position than what the previous panicky sellers were. And once the sellers have exhausted themselves, then typically what you find is that there's a vacuum of selling pressure left behind. And those shares are now in the hands of new shareholders. Now anybody that comes along and wants to buy stock, suddenly there's not this selling pressure anymore. You need to start paying up. And that's when you see this very, very violent bounce that follows on. And you can see it in all of those prior examples where we've had a volume spike after a very aggressive sell-off. The bounce has been pretty vicious. And I'm expecting something similar now on the S&P 500.
Well, we're already seeing it essentially today. So, okay, Garth, so in the context of what's happening on the S&P, what's happening on our own markets, I mean, yesterday was, I think, a record for equities trading on the JSE. They said it smashed all previous records, so there was also a volume spike there. This feeds into a position that you've taken on the market, which is a long one. Yes,
it is a long position, and it's on the top 40 micro contract, with the CFD micro contract that is offered by IG. Now, this is a great little product. What it is it's a CFD that represents the top 40 index, and every contract represents 2 Rand per point. right? And I've done 2 of them for this week's show. So if you think about it, the top 40 trading at around about 43,000 now, times that by 2 rand, it means that your exposure on one contract is 86,000 rand, effectively. We've done 2 of them, so that means that our exposure is double that. It's about 170-odd thousand rand what we've done.
But that's a lot smaller than a normal futures position that you would take.
Yeah, an ordinary SAFEX future is 10 rand per point. Okay, but what is really nice about these IG contracts is that they're smaller, so they're far more accessible to the retail public for people with smaller accounts. Now, why have I done this? Well, obviously, based on everything I've spoken about with the volume spike in the US and the fact that I think that the selling's just got to ridiculous levels and we are due a bounce now. Now, have a look at the top 40 futures chart here. This is an hourly chart, so every candlestick pattern here represents 1 hour worth of trade. There's that downtrend, which goes back only a couple of days or so. It's not very long, but nevertheless, that downtrend is interesting to monitor. But what's really got me interested here is notice the gaps that we've seen. Now, those gaps represent yesterday's trade, being Monday. So we saw a massive gap down in the morning, and then the market traded weaker during the day, etc. But then this morning, Tuesday, we opened stronger. We gap up again. So now we've got 2 gaps on either side of the trading action, as it were. And that's quite rare, and we call that an island reversal. And you can get these things either at a bottom or at a top. But it's called an island reversal because obviously, as the name would suggest, you can see that body of trade is kind of broken away from the rest of the trading action. It looks like an island. And these island reversals are very, very powerful reversals, and they don't come around very often. So when you do see them, usually you get quite a sharp, violent move in the other direction. So that's what's got me excited, as well as the fact that we've broken out above the top of this downtrend now. So based off of that, I've gone long of 2 of these top 40 micro contracts at IG at a price of 42,805 this morning. My stop loss, I'm using 41,900, which would imply that our island reversals then no longer valid if it got down there. So that to me looks good, and I think I'll look for a move up into the sort of 44,500 to maybe 45,000 area to bank profits on this. Remember, I said that our market's likely to encounter a lot of resistance up in that zone, so I'm not going to be too greedy for more. And
this is totally independent of the option structure that you have, so you're not going to, nothing is tied to the other trade, which was the problem that you had last year.
Yeah, this is not tied to the option structure at all. It's got its own independent stop loss, and it's an independent trade. Look, in a certain sense, it helps us to lock in a part of the profit on the option structure, but I'm nevertheless treating this as an independent trade.
Okay, got some greater mechanics. Talk us through that.
All right, so I've gone long 2 of these contracts. Remember, I said each one represents 2 rand per point, and I've done that at 42,805. My stop loss is 41,900. That means that the risk that I'm faced with here is 3,620 rand. That is 1% of our capital. We're sitting with 360,000 rand in capital at the moment, so 1%. Something I've been saying to all my Traders Corner subscribers is that in this volatile environment, you have to reduce your trade size. And that's what we're doing here. We're not taking a full 2% risk here. We're taking a half of that. And I think it's a good idea in a very volatile market to scale back your trading size a bit. The exposure here is effectively 171,000 rand that we're taking to the top 40. My target is 44,500. And that means that our risk-to-reward ratio is about 1 to 1.87.
That's okay, isn't it?
Well, it's okay. It's just there. We like 2 to 1 or better.
Yeah.
But when the market's this volatile, you also got to be careful of putting your stop loss too tight.
Yeah.
And part of the reason why that risk-to-reward ratio is not as smart as it might otherwise be is because I've put that stop loss quite loose.
Okay. Taking all that into account, we haven't spoken about PFG and Zeda, which is a pairs trade that you've got on the go, but we don't actually have time to talk about that. What does the portfolio then look like?
Well, it's looking good. So it's up 44% for the year to date. We've got 360,000 rand in the account, which is a new high for the year. Obviously, that option structure working well for us.
Yeah.
Pioneer and Zeda is losing money, but I'm going to sit on it for another week.
Okay.
And then, of course, we've got that top 40 micro contract, which we've traded today.
Yeah, all right. And bearing in mind that mark-to-market profit on the option structure will only pay off on the 17th of September. So let's see what happens there. Yeah. Garth, any upcoming courses, or are you done for the year for now?
I'm done for now, not for the year. I'll schedule more courses later in the year, but I've had a very busy month of August, and I'm going to give it a rest for a couple of weeks now.
Okay. Yes, pay close attention to what's happening on your trading screen. Garth, thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.
Traders Corner was proudly brought to you by IG. Visit igmarkets.co.za to open a trading account today.